Hello everyone, and welcome to this new video on Trendlines. Today we are going to see what a trendline is and how to develop winning strategies with this tool. We will start by looking at the validation of a trendline, as well as the breakout of a trendline. We will then see different strategies to adopt with trendlines before closing with a quick review. Let's see how to validate a trendline and draw it like a professional. Okay, first of all, you have to know that trend lines are used to identify the ongoing direction of the market, whether bullish or bearish. It's a very useful tool to plot the trend. It's also a dynamic support for uptrends, while it serves as resistance for downtrends. Trend lines exist because investors believe that the past will repeat itself, and a continuation is more often expected than reversal. For example, here, on the Euro-USD currency pair, we have a downward trend line, which I trace right here. And there is a false breakout just here. In another way, for example, here, we have an upward trend line, which tells us that the price is bullish. Now, let's go over 3 rules to validate a trend line. Number 1. A trend line must touch at least 2 highs or lows. The more touches, the stronger it is. Number 2, the trend line shouldn't be too steep, as this may indicate an upcoming reversal to return to the initial trend. And finally, number 3, the trend should be confirmed with the 50-period moving average, which must align in the same direction. Let's see now what these rules give on a graph. So, for example, on the trend line that we had drawn earlier, we can see that there are 6 points of contact, with a false breakout here. And we can also see that, by displaying the 50-period moving average, the latter is decreasing, confirming a bearish trend. Our trend line is therefore validated. In another way, if we go here, we must pay attention to the overly steep trend lines. For example, we have one right there. We could have drawn this, but these trend lines are not very relevant because they break quickly to return to the initial trend, as we can see here. We have several points of contact, with a moving average that goes up globally. Thus, this trend line is also validated. Let's see now the trendline breakouts and how to avoid false breakouts. A false breakout occurs when price breaks the trend line to finally back on the trend line, as these pictures show. So here, 3 important rules to validate a breakout. Number 1, the candle close must be beyond the trend line. Number 2, the breakout movement should be at least 2 times ATR of the breakout candle. ATR is an indicator of volatility. And number 3, a crossover must take place between 20 and 50 moving average to confirm the breakout. So, for example, in this trend line, let's analyze the breakout to see if it was confirmed or not. We can see that there was a crossover between the 20 and 50 moving average. The candles close above the trend line. Rules 1 and 3 are respected. But the movement is too small. In fact, according to rule number 2, we need a 2 times ATR movement to confirm the breakout. So we need an 18 pip movement. But if we measure the movement, we realize that it is too small to confirm the breakout. Let's see another example on Euro-Swiss franc, for example. So the trend line is validated with several touches and an upward moving average. We can see that there is a breakout here. Why is it a false breakout knowing that there is a crossover between the 20 and 50 moving average and candles close below the trend line? It's again because of the movement. It's too small in comparison to the ATR. Indeed, we need a 2 times ATR movement to validate the breakout. If we measure, we need a 17.2 pip movement. The movement is equal to this value, but does not exceed it. The breakout is therefore not confirmed. Let's talk about trendline strategies. The first strategy I want to present you is the trend is your friend strategy. To make this strategy profitable, you have to trade with the trend. The price is used to rebound on the trend line. We will use the 50 moving average indicator as a confirmation signal. Price must be above 50 MA for uptrends and below for downtrends. And finally, we must see a reversal candle to confirm that the price is rebounding, like, for example, a doji, a hammer, or an engulfing. We are here with the New Zealand dollar against the Canadian dollar. We can see that there is a trend line here, which is confirmed by 2 touches and a descending moving average. The price comes here, and a rebound is expected on the trend line. There's additional price action, as this zone is also a resistance zone for the range being formed. The support level of the range is here. A rebound is therefore strongly expected on this area. If a reversal candle forms, we'll be able to enter a short position. And here, we have a kind of doji, which confirms that the price is stabilizing and will probably reverse soon. So we put a stop order at the low of the confirmation candle, a stop loss just above the resistance, and a take profit just above the support to avoid premature rebound. And here we go. Let's now look at a strategy to trade breakouts, that is, to trade a reversal. I'm going to show you a pattern that maximizes your chances of winning, because you will find an infinity of methods on internet. Mine allows you to have a high probability trading, and to be sure that the reversal will happen. I have created a setup for you. The first thing is to analyze the trend. So we were in a bullish trend like this orange trend line shows, and we have a pullback that breaks the trend. Moreover, there has been a crossover between the 20 and the 50 moving average to confirm the breakout. About entry criteria, the breakout must be confirmed with a new pivot low, which is lower than the previous one, indicating a change in trend as we can see here. This pivot low failed at a resistance or support level. Then, there is the formation of the pivot high, which is below the 20 and 50 moving average. Optionally, we can add an indicator such as CCI, which must be below -100. The price is below the moving averages. We set our reward-to-risk ratio to a minimum of 2-to-1, and the trigger is when price breaks the previous pivot low. About position management, we put an initial stop above previous swing high. We move stop to break even after RR ratio reached 1-to-1, and we can put a trail stop above 50 MA with profit locked. We have the same setup for a bullish power reversal that you can see here. Let's see this strategy on a graph. We are going to analyze the New Zealand dollar with the US dollar. So, for example, we can see that there is an upward trend here, confirmed by several touches, and a rising moving average. Then, we see that there is a breakout at this level. We are going to validate the breakout with the movement, which is greater than 2 times the ATR. In addition, there is a crossover of the 20 and 50 moving average here. Our breakout is validated. Concerning the reversal pattern, we have a pivot low which formed here, and which is therefore below the previous pivot low. There is a small rise to form a pivot high, which is here, and which is also below the last pivot high. It indicates that the trend is in the process of reversing. The crossing of the 2 moving averages confirms it. We can therefore open a short position at the break of the pivot low by putting our stop loss above the pivot high and a risk-reward ratio equal to 2. Let's see how the price reacts. It goes down and reaches our take profit. Okay, let's conclude this class with a quick review. First, we saw that trend lines act as support and resistance for the price. We also saw that we have to wait for breakout confirmation before confirming a breakout. Then, we studied the trend is your friend strategy. And finally, we saw how to wait for the perfect setup before trading a reversal of the trend. That's it for Trendlines, guys. Thanks a lot for joining me, and see you soon for the next class.